Hello guys. So moving on to the last video of this capital budgeting. See, already we have recorded some 3 videos for this capital budgeting. So this is the last video. So we'll be covering all the remaining problems in this video. Um, Actually, we have finished the problem number, other exam problems like from problem number 12 to problem number 16. We have already completed in the previous video, I guess. Yeah, problem number 14, 15, 16, all three sums we have completed. So moving on to the other set of examination problem, that is recent examinations problems. These are very important. So max to max recent examination problems will be repeated. See, the other set of problems which I told in the previous video, like problem number 2, 3, 4, 5, 6, those problems I'll just refer it to the institute material I told. So those kinds of problem, it is like age old problems they'll ask, like rarely they'll ask in exam, whereas this examinations problems, like the good thing, the best thing about this material which I like when I was studying also, I know that examination problems is being solved in the class. So that is what exam, like, see how, mm, in exams, no, they at least for some 50 to 60 marks they will ask from the repeated problems. So when we are solving examination problems for all the chapters, we'll have this edge over the other students, that is edge over the other students who are writing the same paper. So they might have studied institute material, they wouldn't have gone through the examination problems. So basically when suppose someone is doing a self study, so what he'll do, he'll just go through all the institute material problems. He'll be full 100% conceptually good in the institute material problems, whereas these examination problems we can't find in the institute material. We can find these problems in the examination questions and answer papers. That is, for if you have your registration number, you can go log in using that registration number and download all the examination question papers and the suggested answers. So in that only we can find these questions. So sir has copied those questions from the material, that is from the question papers and answer papers, suggested answer papers, and he has given those questions in the material. That too, for capital budgeting, it is very important to cover examination problems, because sure shot 8 marks, confirm there will be 7 to 8 marks from the capital budgeting chapter. So it is very important to cover examination problems for this particular chapter. So moving on to the problem number 17. See, triple z co has 4 potential projects, all with an initial cost of 15 lakhs. So it has 4 potential projects, all with initial cost of 15 lakhs. The capital budget for the year will only allow the company to take up only one of 3 projects. So in the question itself they have made a mistake. Triple Z has 3 potential projects. They have given only 3 projects. So three potential projects with all with initial cost of 15 lakhs. So for every project, all the 3 projects, present value of cash outflow is 15 lakhs. So the capital budget for the year will only allow the company to take up only one of the 3 projects. So in this 3, only one can be taken up. Given the discount rates and the future cash flows of each project, which project should they accept? So that is the question they are asking. So using the NPV method, so they are given discounted rates, they are given annual CFAT, which is same for all the years. That is for 5 years, annual CFAT is same. So if you multiply this annual CFAT with the annuity factor at the rate of 4% for 5 years, that is for how many years? 5 years. Annuity factor at the rate of 4% for 5 years into 3,50,000, you will get what is the present value of cash inflow. And if you deduct 15 lakhs, that is present value of cash outflow, from that you will get what is NPV. So you should compare all the 3 NPVs, that is project A, B, C, all 3 NPVs, and suggest which project is acceptable. So same repeated problem. Put heading. You don't have to solve in this method. We'll do like how we are solving in the our own formats. So put the heading. Problem number 17. Problem number 17. Statement number 1. Statement number 1. Calculation of net present value. Calculation of net present value or calculation of net present value. That's all. Underline it. Below that, capital A. Below that, capital A. Record capital A. Project A. Put the heading project A. Underline it. Project A. Underline it. Below that, calculate present value of. Below that, first arrow mark. Below that first arrow mark, present value of cash inflow is equal to present value of cash inflow is present value of cash inflow at what is the discount rate? 4%. Present value of cash inflow at 4%. Present value of cash inflow at 4% is equal to, take down, present value of cash inflow at 4% is equal to ACFAT, that is annual CFAT, ACFAT into annuity factor, ACFAT into annuity factor at the rate of annuity factor at the rate of 4% for 4% for 5 years, at the rate of 4% for 5 years. Below that is equal to, what is the annual CFAT? Below that is equal to, annual CFAT is 3,50,000. So 3,50,000 into 3,50,000 into, check, go to the table, that is annuity factor table. Check what is the annuity factor summation table. That is, you should not see it in the present value interest rate factor table. You should see it in the annuity factor table. What is the annuity factor for 4% for 5 years? We'll just check it once again. Like it will be confusing if I'm not showing it. 4% for 5 years. So this is the annuity factor table. 4% discount rate for 5 years. How much you are getting? 4.452. So 3,50,000 into 4.452 calculated. Below that is equal to 15,58,200. 15,58,200. So that is the present value of cash inflow. Present value of cash inflow is 15,58,200. Below that, small Roman number 2, NPV is equal to present value of cash inflow. NPV is equal to present value of cash inflow minus present value of cash outflow. Below that, how much is the present value of cash inflow for project A? 15,58,200. Below that is equal to 15,58,200 minus what is the present value of cash outflow? 15 lakhs for all the projects they have given. So 15 lakhs. So 15,58,200 minus 15 lakhs. Below that is equal to 58,200. 58,200. 58,200. So that is the NPV for project A. So now come to leave one line gap. Below that leave one line gap, record capital B. Take down project B, underline it. Take down the heading project B and underline it. Below that, small Roman number 1. Present value of cash inflow. Present value of cash inflow at 8%. So what is the discount factor they have given? One second. See, in the question, see, what is the discount factor they have given? 8% for project B. So present value of cash inflow at 8% is equal to, ACFAT into annuity factor at the rate of 8% for 5 years. Annuity factor at the rate of 8% for 5 years. Below that takedown is equal to, how much is the ACFAT? 4 lakhs. How much is the annuity factor for 8% for 5 years? Just check it using the table. You will find the answer. For 8% for 5 years, how much is the annuity factor? Annuity factor you are getting is 3.993. So below that, 4 lakh into 3.993. 4 lakh into 3.993. You are getting, below that record is equal to 15,97,200. 15,97,200, which is nothing but present value of cash inflow. So below that, small Roman number 2. NPV is equal to present value of cash inflow minus present value of cash outflow. minus present value of cash outflow. Below that is equal to 15,97,200. 15,97,200 minus 15 lakhs. Minus 15 lakhs. 15,97,200 minus 15 lakhs. Below that is equal to 97,200. NPV. In respect of that NPV. NPV is equal to 97,200. So that is for project B. Below that capital C. Below that capital C. Put that in project C. Capital C. Put that in project C. Next paragraph, that is capital C, project C. Underline it. Below that, first small room number one. Small room number one. Present value of cash inflow. Present value of cash inflow at 10%, because cost of discounted rate for project C is 10%. So present value of cash inflow at 10% is equal to ACFAT into annuity factor at the rate of 10% at 10% for 5 years. For 5 years. Okay, done. That is formula. Below that, take down. What is the annual CFAT? 5 lakhs. Below that is equal to 5 lakhs into how much is the ACFAT? How much is the discount rate for 10% for 5 years? Check down. For 10%, what is that for 5 years? Check it. For 10% for 5 years, you are getting 3.791. So record 3.791. So 5 lakhs into 3.791. Below that record, calculate 5 lakhs into 3.791. You are getting 18,95,500. 18,95,500. 18,95,500, which is nothing but present value of cash inflow. So below that, small Roman number 2. NPV is equal to present value of cash inflow minus present value of cash outflow. Present value of cash inflow minus present value of cash outflow. How much is the present value of cash inflow here? 3,95,500. Sorry, 18,95,500. 18,95,500 is the present value of cash inflow minus what is the present value of cash outflow? 15 lakhs. Record 15 lakhs. So below that, how much is the value? 18,95,500 minus 15 lakhs. You are getting 3,95,500 is equal to 3,95,500. In respect of that, record NPV. NPV is equal to 3,95,500. So see, with that we have calculated what is the NPV for all 3 projects. So now see in which project the comparatively NPV is higher. 58,200, 97,200, and project C 3,95,500. So among all 3 projects C NPV is higher. So below that record comment NPV is comparatively higher under project C. Hence accept project C. So that is problem number 17. So that is December 2017 exam question. So moving on to the next question. That is problem number 18. June 2018 question, which is my attempt question. In this attempt only I cleared my paper number 10. Okay, problem number 18. Anurag Mills Limited has number of machines that were used to make a product that the firm has phased out of its operations. So Anurag A Limited has number of machines that were used to make a product that the firm has phased out of its operation. An existing machine was originally purchased 6 years ago for 5 lakh rupees. So you have purchased the machine 6 years ago for 5 lakh rupees and is being depreciated by straight line method. Its remaining useful life is 4 years. No salvage value is expected at the end of useful life. So see, simply if you calculate itself 5 lakh, the total useful life is previously you have used for 6 years and its remaining useful life is 4 years. So 5 lakhs divided by 10 years, you are getting 50,000 every year. So what is the value of the machine now? Already 6 years over. So 50,000 into 6, you are getting 3 lakhs. So 5 lakh minus 3 lakh, you are getting remaining 2 lakhs. So 2 lakh is the value of the machine today. It can currently be sold at 1,50,000. So you are going to make a loss of 50,000 if you sell at 1,50,000 because value of machine as per books is 2 lakh. The machine can also be modified to produce another product at a cost of 2 lakhs. See, a machine can be modified to produce another product at a cost of 2 lakhs. So if you remodel this, that is, if you repair this machinery, you can use this machinery for producing another product, but the cost of repair is 2 lakhs. The modification would not affect the useful life. So this, even if you modify, it is going to work only for 4 years, or no salvage value. Salvage value is also not going to get disturbed and would be depreciated using straight line method. Suppose if you are repairing, the remaining amount will be depreciated using straight line method. If firm does not modify the existing machine, it will have to buy a new machine at cost of 4,40,000. So it's going to spend 4,40,000 today if it is not modifying the old machine and purchasing new machine. And the new machine would be depreciated over 4 years. For the old machine also, if you modify 4 years, for new machine also, it is going to be 4 years. The engineers estimate that cash operating profits with new machine would be 25,000 per year, less than with the existing machine. See, cash operating cost, that is the cost which is going to be incurred in cash, that cost is going to cost incurred with new machines would be 25,000 less than the existing machine, which is going to be income. This 25,000 is a savings. If you install new machine instead of modifying the old machine, you are going to save 25,000 rupees cost. Cost of capital is 15% and corporate tax rate is 35%. So cost of capital 15%, discount rate 15%, and corporate tax rate is 35%. So advise the company whether the new machine should be bought out or old equipment should be modified. Assume straight line method of depreciation for tax purpose. So you are going to assume straight line method of depreciation. And loss on sale of existing machine can be claimed as short-term capital loss in the current year itself. If you have already studied direct taxes, you know that if there is any loss on sale of capital gain, you can claim that as an negative balance. That is nearly like tax savings. So here there is some loss because 2 lakhs worth machinery you are going to sell for 1,50,000 if you are buying new machine. So you are going to say loss 50,000. So that is short-term capital loss. On the tax is going to be tax savings. That is 50,000 into 35%. That is going to be 17,500 is going to be a tax savings. Because whenever there is short-term capital loss, you are going to deduct it from the some short-term capital gain. So when there is short-term capital gain, from that if this short-term capital loss is deducted, you are going to save some tax. So that is why when there is short-term capital loss, you are going to get some tax savings. So given present value of annuity factor, that is 15% for 4 years is 2.885. So simple, just understand the question first. There are two options for AM Limited. Either it can modify the old machine and make it use for 4 years, or it can purchase a new machine and use it for 4 years. Only two options available for AM Limited. And out of these two options, if he is going for first option, that is modifying the machine, he is going to modify the machine for 2 lakh rupees. So 2 lakh is going to be spent today. So on the other side, the second option is if he is going to buy new machine, he is going to spend 4,40,000 today, and he is going to receive 1,50,000 today. And one more thing is he is going to have a tax savings on the short-term capital loss. So that is the more than that, there is some cost which is being saved if there is change in machinery. That is, if new machinery has been purchased, instead of modifying the old machinery, you can save up to 25,000 per year as cost savings, because this new machine will give less cash operating cost. That is, we'll be spending less cash operating cost of 25,000 rupees compared to the old machine. So that is the question they have given. With that, we should solve the answer. See, simple man. If you are calculating what is the incremental cost of purchasing new machine and what is the incremental savings on purchasing new machine. If it is giving positive, then you should purchase new machine. If it is giving negative balance of NPV, then you should modify the old machine. So now come to the solution. Problem number 18. Statement number 1. Calculation of net cash outflows. On purchase of new machinery. Below that, two columnar table. First column particulars, second column amount. So below that particulars record small a, price of new machine, purchase price of new machine. How much is the purchase price of new machine they have given? It will have to buy a new machine at a cost of 4,40,000, no salvage value. So in respect of price of new machine record 4,40,000. Below that, if suppose you are purchasing new machine, you are going to sell the old machine for 1,50,000. So below that, less sale proceeds of existing machine. 1,50,000 within bracket. 1,50,000 amount column record 1,50,000 within bracket. 1,50,000 within bracket. That is sale proceeds means cash is coming in. So you are calculating what is cash outflow. When cash is coming in, it is opposite entry, that is cash inflow. So you are deducting it. Again below that, less, because of selling for 1,50,000, you are incurring 50,000 short-term capital loss. So on the tax percent will be the tax savings. Below that, less tax savings on loss on sale of existing machine. Tax savings on loss of the sale of existing machine. How much is the loss in you are incurring? Just remember this calculation. You don't have to separately work out. See, simply remember 5 lakh is the total cost of machinery. Already 6 years you have worked and remaining 4 years is available. So 6 plus 4 is 10 years. So total life of the machinery is 10 years and there is no salvage value expected at the end of the useful life. So entire 5 lakh should be depreciated. So 5 lakh divided by 10 years, you are going to get 50,000. Fine. 50,000 is the depreciation per year. So you have already completed 6 years of usage. So 3 lakh has been depreciated already. So remaining value of machine is 5 lakh minus 3 lakh, you are getting 2 lakh rupees. So 2 lakh is the value of machinery on the day of sale. So 2 lakh machinery worth, 2 lakh worth machinery, you are going to sell it for 1,50,000. So you are going to make a short-term capital loss of 50,000. Short-term capital loss of 50,000. You don't have to tell it is short-term capital loss. You can tell us capital loss also. Tax savings on loss of sale of existing machine. Tax savings on loss on sale of existing machine. How much is the book value? Within below that open a bracket. 2 lakhs. That is the 2 lakhs is the book value, because 2 lakhs minus 3 lakhs you are getting 5 lakhs minus 3 lakhs you are getting 2 lakhs. So 2 lakhs. Just remember how you are getting 2 lakhs. Don't forget that. 5 lakh minus 3 lakhs, so you are getting 2 lakhs. So 2 lakh minus, how much is the sale value? 1,50,000. 2 lakh minus 1,50,000. So loss is 50,000 rupees. 2 lakh minus 1,50,000 into 35%. That is the tax savings amount. 2 lakhs minus 1,50,000 into 35%. So in respect of amount column record 17,500 within bracket. 17,500 within bracket. That is the cash inflow actually. So you are going to get tax savings. So you are going to pay less. So that is ultimately cash inflow. So you are deducting it because this is cash outflow table. You are deducting it from the purchase price of new machine. Within bracket 17,500. And one more important thing they have given. See, the machine can be also modified to produce another product at the cost of 2 lakh rupees. The modification would not affect the useful life or salvage value and would be depreciated using the straight line method. So understand it clearly. This 2 lakh rupees, if you spend, then only you can use the old machinery. That is point number 1. And point number 2 is, even if you spend 2 lakh, it is going to give the same life, and there won't be any salvage value. So the useful life and salvage value and all is same as per the previous situation. That is before spending 2 lakh rupees. So this 2 lakh rupees, if you are purchasing new machinery, you are not going to incur this 2 lakh rupees. So it is ultimately cash inflow. See, if suppose instead of modifying old machinery, you are going for new machinery. So you are purchasing 4,40,000. Then you are not going to incur this 2 lakh modification cost. So that is tax. Sorry, that is cash inflow. So below that less modification avoided if new machinery is bought. Modification avoided if new machinery is bought. How much is the modification amount you are going to avoid? 2 lakh rupees. If suppose you are purchasing new machinery, you are going to avoid this 2 lakh rupees expenses. So in respect of that modification avoided if new machinery is bought, record 2 lakh within bracket. 2 lakh within bracket. Now total it 4 lakh minus 1 lakh 50 minus 17,500 minus 2 lakh. 4 lakh 40 minus 1 lakh 50 minus 75,000 minus 2 lakh. You are getting, how much is that you are getting? 4 lakh 40,000 less 1 lakh 50,000 less 17,500 less 2 lakhs. You are getting 72,500. So total it, amount column total it 72,500. In respect of that 72,500, record net cash outflows. Net cash outflows. Net cash outflows. Below that statement number 2. Below that statement number 2, calculation of net cash or else calculation of NPV. Calculation of net present value. Below that 2 columnar table. Below that 2 columnar table. First column particulars, second column amount. First column particulars, second column amount. In respect of particulars, record small a cost savings. Cost savings. How much is the cost you are going to save if you are purchasing new machinery? So that is a cash inflow. So you should first take down what are all the cash inflows, then you should deduct the present value of cash outflow. So you will get what is the NPV. So first to calculate what are the cash inflows. Here you are going to get cost savings of 25,000 rupees if you are installing new machinery. So below that small a, cost savings, outer amount column record 25,000. Amount column record 25,000. Below that add difference in depreciation. So see, if suppose, understand this difference in depreciation. If suppose you are going with old machinery, then how much is your total machinery value? Existing value 2 lakhs. Okay, existing value, that is 5 lakh minus 3 lakh, you are getting 2 lakhs. Upon that, you are spending 2 lakh rupees again for the modification. So total 4 lakhs. 4 lakhs you are going to use the machinery for only 4 years. So the depreciation for under the modification option of old machine is 1 lakh rupees. Whereas for this new machine is 4,40,000 minus 0 salvage value, that is 4,40,000 divided by 4, you are getting 1,10,000. So depreciation for new machinery is 1,10,000 and for modifying the old machinery is 1 lakh. So difference is 10,000 rupees. So suppose instead of modifying the old machine, if you are going for new machine, you are going to get cost savings of that is, see, understand it. When depreciation is more, when depreciation is comparatively more compared to the old machinery, that is compared to old machinery, when depreciation for new machinery is more, you are going to get tax saving, that is profits minus depreciation. You are going to get what is PBT. From that you will deduct tax on that profit after tax. Upon that you will be adding the depreciation again. So the difference in depreciation, that is increase in depreciation, is normally called as income. Decrease in depreciation is called as expense. So here there is increase in depreciation. So you are going to save, you are going to deduct it from the profits, that incremental depreciation, and you are going to add it back to the PAT. So increment in depreciation, that is increase in depreciation, is an income. So below that differential depreciation within bracket 1,10,000 minus 1 lakh. So you know how we calculated this 1,10,000 and 1 lakh. 1,10,000 is nothing but 4,40,000 divided by 4, and old machinery, that is for modification 2 lakhs is the existing value plus 2 lakh is the modification. So 4 lakh is the total value of modified machine, divided by 4, you are getting 1 lakh. So 1,10,000 minus 1 lakh. Amount column, outer amount column, that is only amount column record 10,000. Now amount column total it. Amount column total it. 25,000 plus 10,000. You are getting 35,000. 35,000. So below that, in respect of that record, total cash advantage per year before tax. Total cash advantage per year before tax. On that, less tax at the rate of 35%. Tax at the rate of 35%. Tax at the rate of 35%. So how much is the, one second. One second. $35,000 plus 10,000, that is 35,000 into 35%. You are getting 12,250. 35,000, you are getting 22,750. Whereas 25,000 into 35%. 25,000 into 65% plus 10,000 into 65%. Hey, how come, man? 25,000 into sorry, this differential depreciation, you should deduct it from the cost savings, because this increase in depreciation is going to tax you more. See, when they see, simple, I'll just give you a clear example. Suppose net profit is 1 lakh rupees. On that net profit, if you are deducting depreciation of 50,000, then your profit before tax is 50,000. If suppose your depreciation is increasing, from 50,000 to 60,000, you are going to pay one tax amount only on 40,000. So like if depreciation has been increased to 60,000, so 1 lakh minus 60,000, 40,000. On that 40,000 only you are going to pay tax. That 60,000 you are going to again add it to the cost by as a CFAT plus. For CFAT you are going to add depreciation to the PAT. Whereas when your depreciation is decreasing, that is when your depreciation is decreasing, then it is going to be a loss for you. You are going to deduct it from your net profit. So here on cost savings, 25,000 into 65% and differential depreciation. Okay, deducted cost savings. Below that, total cash advantage per year. Total cash advantage per year. Actually, strike this table. Strike out this table. Actually, cancel this table. Again, record it below. Statement number 2. Statement number 2. Calculation of NPV. Calculation of NPV. Below that, 3 columnar table. Below the 3 columnar table, first column particulars, second column before tax, third column after tax. Particulars before tax and after tax. Below that, particulars record small a, cost savings on purchase of new machinery. Cost savings on purchase of new machinery. How much is the total cost savings? 25,000. That is cost savings for purchase of new machinery. So in respect of before tax column, that is inner amount column, record 25,000, and outer amount column record 25,000 into 65%. See, on cost savings, how much you are going to save? 25,000 is your total savings. On that 25,000, you are going to pay 35,000 tax. That is 8,750. Remaining is your amount after tax. So 25,000 minus 8,750, you are getting 16,250 is the after tax, which is your saving. So in respect of amount after tax, that is outer amount column record 16,250. 16,250. Below that, add differential depreciation. Differential depreciation. Open a bracket. I have already explained what is 1 lakh and 1,10,000. So open a bracket. 1,10,000 minus 1 lakh. 1,10,000 minus 1 lakh. Amount before tax. Amount before tax. That is in respect of amount before tax, record 10,000. 10,000. So the differential depreciation is 10,000. On this differential depreciation, if suppose there is increasing depreciation, on the depreciation amount you are going to save some tax. That is whatever the tax amount which you should have paid. Suppose there is no increment in depreciation. The depreciation is like old machinery only, like how it was for previous old machinery, same for the new machinery. Then you are going to pay tax for that 10,000. See, suppose if it is not 1,10,000 and 1 lakh, if suppose it is 1 lakh, then 1 lakh minus 1 lakh differential depreciation is 0. So that this excess 10,000 which you claimed as depreciation, now you wouldn't have claimed depreciation. Then on the 10,000 you should have paid 35% tax. So that 35% of amount is the tax savings now for you. So amount before tax column 10,000 and amount after tax column 10,000 into 35% is the amount saved because of additional depreciation. So in respect of after tax column, record 3,500. In respect of after tax column, record 3,500. Now after tax column, total it 16,250 is the total cost savings you are doing, and 3,500 is nothing but because of additional depreciation you are having some tax savings. So total is 19,750. 19,750. In respect of the 19,750, record total cash advantage per year. Total cash advantage per year. So that is the cash inflow per year. Total cash inflow. In the below that record annuity factor. Below that record annuity factor, small d, annuity factor at the rate of 15% for 4 years. At 15% for 4 years. How much is the value they have given? They have given directly that it is 2.855. So amount outer amount column, that is after tax column, record 2.855. 2.855. Below that annuity factor record. Below that record present value of cash inflows. Present value of cash inflows from buying new machine. From buying new machine. So 19,750 into 2.855. You are getting 56,386. 56,386. So present value of future present value of cash inflow from buying a new machine is 56,386. 56,386. Below that record less present value of cash outflow. Present value of cash outflow in respect of outer amount column, that is after tax column, record 72,500 in bracket. 72,500 in bracket. Within bracket 72,500. So now outer amount column, total it 56,386 minus 72,500. You are getting 16,114 within bracket. Underline it. 16,114 within bracket. In respect of that 16,114, record NPV. Record NPV for buying a new machine. NPV for buying a new machine. So if you are buying a new machine, you are going to have a negative NPV. That is, you are going to lose money. Your NPV is negative, so it is not advisable to purchase new machinery. It is going to it is advisable to go with modifying the old machinery. So below that record comment. Below that record comment. It shows negative. It shows negative NPV. It shows negative NPV for purchase of new machinery, it shows negative NPV for purchase of new machinery. Hence, full stop. Hence, comma, it is advisable to go with modification of old machinery. To go with modification of old machinery. So that is problem number 18. So with that we have completed problem number 18. So next is moving on to problem number 19. Moving on to problem number 19. What they have given? Z Limited. So first we will read the question, that is December 2018 question. Z Limited is faced with problems of choosing between two mutually exclusive projects A and B. Again, project A, B. Project A requires cash outlay of 10 lakhs and cash running expenses of 3,50,000 per year. On the other hand, project B will cost 15 lakhs and requires cash running expenses of 2 lakhs per annum. So cash outlay, that is for first year, in previous year, that is beginning year. At the beginning of the year, first year itself, cash outlay is 10 lakhs, and for every year it is 3,50,000. And for project B, beginning of the year, first year is 15 lakhs, and cash running expenses is 2 lakhs per year. So both the projects have 8-year life. So you can use NPV because there is no time disparity. And project A has salvage value of 40,000. Project B has salvage value of 1,40,000. The company's tax rate is 50% and it has 10% required rate of return. So tax is 50%, required rate of return is 10%, and salvage values for project A is 40 and project B is 1,40,000. Below that required, assume depreciation on straight line basis and that there is no funds constraints for the company. Ascertain which project should be accepted. So you have to go with NPV analysis so that you can ascertain which project is more preferable. Given present value of annuity factor for 10 years, 10% for 8 years is 5.335, and for 10% for 8 years is, for 8th year is 0.467. See, 10% for 8 years is 5.335 and 10% for 8th year is 0.467. See, this 5.335 is annuity factor, summation of first year to 8th year, whereas this 0.467 is nothing but present value factor for the 8th year at 10%. So below that note, solve the problem by an incremental cash flow approach. This is the first time in December 2018 question paper they told this particular note, that is solve the problem by incremental cash flow approach. So normally what we were doing from the first problem to last problem, before problem, we did like, first we will calculate what is NPV for project A, then we will calculate what is the NPV for project B, then we will see where NPV is higher, then we will accept the project or to reject the project. Whereas here what they have asked is, they have given two options and also they have asked us to calculate the that is select the project using incremental cash flow approach. Incremental cash flow is nothing but project A, project B. So difference of project A and project B is incremental. So that is how we should calculate using incremental cash flow approach. So here project A cash outlay is 10 lakhs, project B is 15 lakhs. So we'll just deduct project A minus project B. So if NPV is positive or negative, based on that we will select project A or project B. So we have understood this sum clearly, like project A, project B are there. Project A cash outlay is 10 lakhs at the beginning and 3,50,000 every year. Project B 15 lakhs at the beginning and 2 lakh rupees every year. Both the projects have 8-year life, and tax rate is 50%, required rate of return is 10%, and salvage value for project A is 40,000, project B is 1,40,000. So below that, take down next problem. Problem number 19. Problem number 19. Statement number one. Calculation of evaluation of projects using incremental cash flow approach. evaluation of projects using incremental cash flow approach. Incremental cash flow approach. Below that 4 columnar table. First column particulars, second column project A, third column project B, and fourth column incremental cash flows. That is within bracket A minus B. That is within bracket A minus B. Within bracket A minus B. So you can evaluate this particular problem to projects based on total cash outflow. That is present value of cash outflow we should calculate. Under which option present value of cash outflow is less, then you should accept that project. So that is how we would have calculated. Now we are using incremental cash flow. So using that we should calculate which project is acceptable. So below that particulars record cash outflows at the beginning of the year. Cash outflows at the beginning of year 0. At the beginning of year 0. In respect of project A, column record 10 lakhs because the project A cash outlay is 10 lakhs and project B 15 lakhs. Project B 15 lakhs. So how much is the incremental cash outflow in respect of project B from project A? Project A is 10 lakhs, project B is 15 lakhs. So extra incremental cash outflow is 5 lakhs. So incremental cash flow column record 5 lakhs. Incremental cash outflow column record 5 lakhs. Below that cash running expenses. Below that cash running expenses. Project A column record 3 lakh 50. Project B column record 2 lakhs. They have given 3 lakh 50 for project A and 2 lakhs for project B. Project B. So that is cash running expenses. And also we should also calculate what is the depreciation, and the difference in depreciation is also a cash outflow or cash inflow. So below that depreciation, under project A, what is the depreciation? Just check. Below that cash running expenses record depreciation. The depreciation is nothing but tax savings. See, when there is increase in depreciation, there is always savings in tax. That is, if depreciation is more, then you are going to show less profits for taxation, then you will pay tax less. So the tax savings amount is in the depreciation is nothing but cash inflow. So in respect of depreciation column record depreciation for project A, how much? Cash outlay is 10 lakhs. Cash outlay is 10 lakhs and salvage value is 40,000. Sorry, cash outlay is 10 lakhs. Project salvage value is 40,000. 10 lakhs minus 40,000, you are getting 9 lakh 60 divided by 8 years. You are getting 1 lakh 20,000. So in respect of, see, number of years is 8 years. So 10 lakhs minus 40,000 divided by 8, you are getting 1 lakh 20,000. So in respect of project A, record 1 lakh 20,000. 1 lakh 20,000. And project B, calculate 15 lakhs minus 1 lakh 40,000 divided by 8, you are getting some 1 lakh 70,000. So in respect of project B, record 1 lakh 70,000. 1 lakh 70,000. So project A is 1 lakh 20,000, project B is 1 lakh 70,000. So how much is the incremental depreciation? That is, if suppose you are going with project A, it is 1 lakh 20,000 depreciation. If you are going with project B, it is 1 lakh 70,000. So compared to project A, project B, there is so much tax savings. So if you deduct both, it is answer is coming in negative. So within bracket A minus B, within bracket 50,000. Within bracket 50,000. If suppose you are going with project B, then 50,000 is the additional tax savings you are going to get. That is additional depreciation on which you are going to get tax savings. So 50,000. 50,000. So below that total savings. Total savings. So how much is the total savings every month you are making, like every year you are making? 1,50,000 is the cash running expenses which project A is making extra, that is incremental cash outflow, whereas project A is losing its depreciation option, that 50,000. So 1,50,000 minus 50,000, totally you will get 1 lakh rupees. 1 lakh. Total savings 1 lakh. Total savings 1 lakh. Below that, less tax. How much is the tax percent they are given? Less tax at the rate of 50%. Tax at the rate of 50% on total savings. That is 1 lakh into 50%. You are getting 50,000. So within bracket 50,000. Within bracket 50,000. 50,000. Below that, savings after tax. Savings after tax. That is 50,000. Totally, that is 50,000. 1 lakh minus 50,000. You are getting 50,000. On that 50,000, add depreciation not being cash outflow. Depreciation, because depreciation is a non-cash expense. So here you deducted 50,000, so you are adding back 50,000. So add depreciation not being cash outflow 50,000. 50,000. So if you add both 50,000 plus 50,000, now total it. Total it, record 1 lakh rupees. Total it, below that record 1 lakh rupees. In respect of that 1 lakh rupees, record net savings. Net savings. Net savings. So 1 lakh rupees is the net savings. On that 1 lakh rupees every year, multiply with what is the annuity factor for 8 years for 10%. You will get what is the present value. And then for 8th year, that is at the end of 8th year, you are going to get salvage values for both the options. That is project A and project B, you are going to get some salvage values. So you should compare that and see what is the incremental cash outflow. So let's below that record salvage value at the end of year 8. Salvage value at the end of year 8. Project A is 1 lakh, project B is 1,40,000. Because this is present value of cash inflow. See, normally salvage value is a cash inflow. Here we are calculating what is cash outflows. But here the salvage value is nothing but at the end of year 8, you are going to receive income. So it is a positive income. So project A is going to receive 40,000. Project B is going to receive 1,40,000. So comparatively, project B is on safer side. So incremental cash flow column record 1 lakh because it is opposite entry. That is, we are calculating what is the total cash outflow. Now we calculated net savings, that is 1 lakh rupees, and we are calculating salvage value at the end of year 8, that is 40,000 for project A and project B 1,40,000. This is cash inflow. So 40,000 minus 1,40,000, you will get 1 lakh minus 1 lakh. Whereas this is minus, the salvage value is nothing but minus, so it has become positive here. So in respect of amount column, record 1 lakh. Amount column, that is incremental cash flow column, record 1 lakh. So 1 lakh is the extra cash which you are losing if you are not going with project B and going with project A. So below that record present value of cash inflows. Present value of cash inflows. Present value of cash inflows. Below that present value of cash inflows, first arrow mark, present value of net savings. Present value of net savings. How much is the net savings? 1 lakh. So present value of net savings, open a bracket. 1 lakh into how much is the annuity factor? 5.335. So 1 lakh into 5.335. Incremental cash flows column, record 5,33,500. 5,33,500. And below that, second arrow mark. Present value of net salvage value. Present value of net salvage value. So within bracket, 1 lakh into at the end of year 8, what is the PV factor? 0.467. Within bracket, 1 lakh into 0.467. You are getting 46,700. So both these are advantage if you are going with project B. See, simple man. Project A if you are going and project B if you are going. If you are going with project A, you are going to lose this extra net savings of 1 lakh rupees. How did we calculate that? We compared both the cash outflows. From that we calculated that 1 lakh rupees is the cash additional cash inflow. That is net savings which you are going to get if you are going with project B. And salvage value is nothing but total net savings at the end of year 8. So year 8, when you are selling the machinery, you are going to get some salvage value, that is positive income. So cash inflow. So if you are going with project A, you are going to get only 40,000 as cash. Whereas project B, you are going to get 1,40,000. When you compare both, for project B, there is 1 lakh rupees higher you are going to get. So that is also a cash inflow. So if you add both, you are going to get for 1 lakh, you are going to get every year. So 1 lakh into annuity factor for 8 years. This 1 lakh you are going to get only for last year, 8th year, that is salvage value. So 1 lakh into last year PV factor, that is 0.467. So if you add both, so total it, incremental cash flows column, total it 5,33,500, 5,33,500 plus 46,700 plus 46,700, you are getting, how much you are getting? 5,80,200. 5,80,200. So in respect of that 5,80,200, record present value of cash inflows. Present value of cash inflows. Below that, less cash outflow. Less present value of cash outflow. How much is the cash outflow which you are going? If you are going with project A, 10 lakhs only. Project B, 15 lakhs. So because of going with project B, that incremental amount is 5 lakhs. So in respect of that present value of cash outflow, less present value of cash outflow, incremental, within bracket incremental amount, that is incremental cash flows column, record 5 lakhs within bracket. 5 lakhs within bracket. So now total it, 5,80,000 minus 5 lakh, you are going to get what is net present value, that is 80,200. So below that, record 80,200. In respect of that 80,200, record net present value. In respect of that 80,200, record net present value. Net present value. Below that, comment. See, there is positive net present value because of incremental cash flows. Then incremental cash flows is positive, so you should go with project B instead of project A, because there is incremental positive cash inflow, incremental positive net present value. So you should go with project B. Comment. Below that, record comment. Since project B has positive NPV, over and above the NPV of project A, project B is recommended for acceptance. See, I'll give you, just finish off this comment. Project B is recommended for acceptance. So project B should be accepted. So I'll give you one more suggestion of solving this. See, suppose if this particular institute material format is very disturbing, what you should do is first calculate what is, see, just take a put a statement, calculation of NPV for using incremental cash flow approach. You just put a statement in. Then what you should do is put 4 columnar table, particulars, project A, project B, and incremental. Just calculate what are all the different cash outflows, then total it. Here only one cash outflow, that is one cash outflow, that is how much is that? Sorry, there are two cash outflows, that is the cash outflows and the cash running expenses. So total and multiply those things with the present value factors. Then what you will get? You will get to present value of total cash outflow for both the project. Total it. That final amount of present value of cash outflows for both the project is there. No, that one compare project A and project B, where deduct A minus B, you will get incremental cash flows. Instead of going with each item incremental, you can total what is the present value of cash outflows, then compare it, take outside that incremental present value of cash outflows. Then do what is it for incremental cash inflow. Then do present value of cash inflow for project A, project B. Then total, just compare it, take outside the incremental cash inflow. Compare the incremental cash inflow minus the incremental cash outflow, you will get what is the incremental NPV. So if your incremental NPV is positive, accept project B. If your incremental NPV is negative, accept project A. That's all. Simple. Very easy concept, but this institute material format, because this institute material, it will be like that only. Like it will be very hard to understand the concept using this institute material. Whereas if you are solving the problem on your own, after 1 month, if you see also, you can at least grab, okay, why this is why I have written this. But then reading it only in institute material, these kinds of formats, if you open the book after 1 week also, it will be very hard to remember. So that is problem number 90. So moving on to the last problem, problem number 20. Problem number 20. E Limited has suggested E Limited has suggested installed machine A at cost 2 lakhs. This machine has 5 years life with no residual value. The annual volume of production is estimated at 1,50,000 units, which can be sold at 8 per unit. Annual operating costs are estimated at 2 lakhs, excluding depreciation at the output level. Fixed costs are estimated at 4,50,000 per annum for the same level of production. See, the company has just come across another model called Machine B, capable of giving the same output at an annual operating cost of 1,50,000, excluding depreciation. Excluding depreciation. 1 second. See what they have told. The company has just come across another model called Machine B, capable of giving the same output at an annual operating cost of 1,50,000. Where if under like Machine A, annual operating cost is 2 lakh, whereas under Machine B, annual operating cost excluding depreciation is only 1,50,000. 50,000 you are going to save per annum. There will be no change in fixed cost. Capital cost of the machinery is 2,50,000. Here, Machine A cost is 2 lakh, Machine B cost is 2,50,000. So only in the beginning of the year you are going to spend 2,50,000. Then you will be spending only 1,50,000 every year, whereas Machine A beginning of the year it will spend 2 lakh, and every year it will be spending again annual operating cost of 2 lakhs every year. So and the estimated life is 5 years with no residual value. For both the machines, no residual value, and the estimated life is 5 years. The company has an offer for sale of Machine A at 1 lakh rupees. But the cost of dismantling and removing will amount to 30,000. So remaining amount is the income, that is inflow, that is 70,000. As the company has not yet commenced the operation, it wants to sell Machine A and purchase Machine B. So incremental, simple man, it want to sell Machine A to purchase Machine B. So what is the incremental cash inflows? If incremental cash inflow is positive, that is incremental NPV, then go with the Machine B. If there is negative incremental NPV, then go with Machine A itself. So E Limited will be zero tax company for 7 years in view of several incentives and allowance available. The cost of capital is 14%. So using this, we should same method, same concept, incremental cash inflow we should find. So recent exams they are asking this incremental cash flow approach only. So what they should do is you should find using the incremental cash inflow. Just compare the Machine A with Machine B. So what are all the incremental cash outflows and what are all the incremental cash inflows? If you compare both, you will get what is the NPV, incremental NPV. If incremental NPV is positive, then go with Machine B. If it is negative, go with Machine A. Based off NPV criterion, advise the company whether using NPV method it is asking. Advise the company whether it should opt to replace Machine A by installing Machine B. Given present value factors, that is annuity factor 14%, 5 years is 3.433, and for present value factor is for 14%, 50 year is 0.519. Solve the problem by an incremental cash flow approach. See, in the recent examinations, they are asking the same thing, that is incremental cash flow approach. So in this incremental cash flow approach, you should be very thorough. Okay, June 2019 attempt. So come to the solution. So now you have two options, Machine A and Machine B. Okay, if you are going with Machine A, you don't have to do anything, like you will only spend extra 50,000 on annual production cost. Whereas if you are going with Machine B, you will sell the Machine A at 1 lakh, purchase the Machine B at 2 lakh 50. So this 1 lakh minus 30,000 is spending 70,000. So 2 lakh 50 minus 70, that is 1 lakh 80,000 you are going to spend at the beginning of the year, and you are going to save 50,000 every year annual operating cost. Upon that, the machine, there is increase in capital cost of the machine, 2 lakh 50 compared to 2 lakh. So depreciation is going to increase. So there is some tax savings because of increase in depreciation. So cash inflows are two: increase in depreciation and savings in annual operating cost. And cash outflows are only one, that is sale value of machine minus, sorry, purchase price of machine minus sale value of old machine. You will get what is the incremental cash outflow. That is what is the incremental cash outflow. Okay, below that take down. Now moving on to the solution. Problem number 20. Problem number 20. Statement number 1. Statement number 1. Statement number 1. Calculation of net cash outflow. Present value of calculation of present value of net cash outflow. Calculation of present value of net cash outflow. Net cash outflow. Below that 3 columnar table. Below the 3 columnar table, first column particulars, second column amount, third column also amount. Particulars, amount and amount. What is the net cash outflow they are asking? What is the cash outflow here? You are purchasing the machine by selling the old machine. So whether you should install the machine B or not, using the incremental cash approach, they are asking us whether you should install machine B or not. So we should calculate what is the net cash outflow. Then into PV factor, you will get what is the present value of net cash outflow. Here you are going to expend on the year 0, that is beginning of the year itself. So whatever the amount is coming into 1 is the present value of cash outflow. So below that, 3 columnar table, particulars, amount and amount. Below that particulars record. Small a, cost of machine B. Cost of machine B, outer amount column record 2,50,000. Outer amount column record 2,50,000. Below that less, sale proceeds of machine A. Sale proceeds of machine A. So for what value you are selling the machine A? Sale proceeds of machine A. You are selling it at 1 lakh. So inner amount column record 1 lakh. Inner amount column record 1 lakh. Below that, cost of dismantling and removal. So for selling that machinery, you should incur some cost in order to remove that. Suppose, see, if it is a huge machinery, then for taking that machinery outside your factory, you have to use your labor. Then you have to use some like transportation something in order to transfer the machine. So these are the different dismantling and removal costs which you are going to incur. That is a cost incurred. For selling a product, it is simply like selling expenses. So to sell a product, you are incurring some expenses. So you should deduct it from the value so that you will get the ultimate net profits from that sale. So below that, cost of dismantling and removal. Inner amount column record within bracket 30,000. Inner amount column record within bracket 30,000. So inner amount column total it. Record outer column, how much is the total net profit you are going to get? 1 lakh minus 30,000, you are getting 70,000. So outer amount column record 70,000 within bracket. 70,000 within bracket. So this is the sale process which you are going to get, amount which you are going to receive today by selling the machine. And for purchasing the machine, you should spend 2,50,000. So 2,50,000 minus 70,000. Outer amount column total 1,80,000. 1,80,000, which is nothing but 1,80,000. In respect of that record, present value of cash outflow. Present value of cash outflow. Present value of cash outflow. Below that, statement number 2. Statement number 2, calculation of net present value. Calculation of incremental net present value. Calculation of incremental net present value. Below that, 4 columnar table. Below that, 4 columnar table. First column particulars. Second column machine A. Third column machine B. And last column incremental. Within bracket A minus B. Last column incremental within bracket A minus B. A minus B. So first record, what are the incremental cash inflows? So in respect of below the particulars, first record, what is the tax savings which you are making? Just don't copy this format. I'll just explain you the easy format. So here annual operating cost you are going to save 50,000 because for machine A it is 2 lakhs and for machine B it is only 1,50,000 annual operating cost. So first record operating cost in respect of machine A 2 lakhs and in respect of machine B 1,50,000. Machine B 1,50,000. So what is the incremental you are going to save cash inflow you are going to save 50,000. So incremental column record 50,000. 50,000. So now what else is the tax savings which you are getting? What else are the savings which you are getting from converting from machine A to machine B? Machine A cost, machine A is total cost value is 2 lakhs. Life of the machinery is 5 years. Machine B is 2,50,000. Life of the machinery is 5 years. So your depreciation is going to be more under machine B. So there is going to be incremental depreciation. But whereas, remember this point, very important key point. Machine A, suppose 2 lakh divided by 5, 40,000. Machine B, 2,50,000 divided by 5, that is 50,000. So incremental depreciation is 10,000. So you will get tax savings of 10,000, not 10,000 into tax percentage. But in this particular sum, E Limited will be zero tax company. See, zero tax company. So if it is zero tax company, there is no taxation itself. So because of this increase in depreciation, you are not going to get any tax savings. So there is no present value of cash in. So there is no cash inflow because of this increase in depreciation. Understand it. See, for machine A, depreciation is 40,000. For machine B, depreciation is 50,000. So there is 10,000 increase in depreciation. So the 10,000 rupees increase is there. No. If suppose this company belongs to 20% tax, then 10,000 into 20%, you are going to get 2,000 rupees cash inflow, tax savings. Because it is 0%, so there is no use of incremental depreciation. If there is only tax, then only there will be tax savings in incremental depreciation. So here tax percentage is 0. So there is no incremental tax savings. That is, there is no tax savings on the incremental depreciation. So cash inflows is only one thing, that is operating cost. So 2 lakhs minus 1,50,000, 50,000. So that is the cash inflow. Below that, net cash inflow. Sorry, not below that. Record PV factor, annuity factor. That is annuity factor at the rate of 14%. At the rate of 14% for 5 years. For 5 years. Incremental column record it. Incremental column record below that 50,000 record 3.443. 3.443. Annuity factor at the rate of 14% for 5 years 3.443. Now incremental column, total it, underline it, multiply 50,000 into 3.443. 3.433, sorry, 3.433. Below that, in total column record 1,71,650. 1,71,650. So in respect of that 1,71,650 record, present value of cash inflow. Present value of cash inflow. Present value of cash inflow. So below that present value of cash inflow record less present value of cash outflow. Present value of cash outflow. How much is the present value of cash outflow? 1,80,000, because this 1,80,000 you are going to spend on the beginning of the year 0 itself. So 1,80,000 into 1, you are getting 1,80,000 only. So in respect of incremental column, record within bracket 1,80,000. Within bracket 1,80,000. So now deducted amount column, that is incremental column, total it 1,71,650 minus 1,80,000. Minus 1,80,000. Below that, underline it, record 8,350. 8,350 within bracket. Negative. Within bracket 8,350. So in respect of that 8,350 record net present value. In respect of that 8,350 record net present value. Net present value. So here net present value is negative. If you go for machine B, incremental net present value is negative. So you are going to lose money. So it is not advisable to go for machine B. So below that, comment, record comment as record comment net present value incremental, sorry, incremental net present value. Incremental net present value is negative. Hence is negative, comma, hence it is not advisable, comma, hence it is not advisable to replace the machinery. To replace the machinery or to replace the machine with machine B. To replace the machine. To replace the machine A with machine B. Incremental NPV of machine B is negative, hence it is not advisable to replace the machine A with machine B. Machine A with machine B. So that is the comment which we found from the problem number 20. So just work out all these 7 problems, that is problem number 14, 15, 16, 17, 18, 19, 20 very clearly. You should be very thorough with the concepts so that pakka exam question will definitely be from this only. You don't have to go for before all 14 problems also. If you are thorough with all these 7 problems, pakka you will get, because this for normal problems and all we did know, like what we did, NPV calculations, then we did some ARR calculation, and we were doing this calculation of filling the table. I'm missing, that is profitability index. All those IRR they might ask exam. They might ask IRR. Be very thorough, and this 7 problems be very thorough, so that you might get a repeated question. See, problem number 17 in December 2017 and problem number 18 are so similar. so similar. This problem was 17. See, before June 2017, sorry, June 2017 question and December 2017 question were so similar. So they are simply asked to evaluate the project using discount rate. Here also same thing, evaluate the project using discount rate. So one after the other exam, the questions will be similar. So either they will experiment. It's not like BCom exams, they will give 100 marks very easily. They will experiment, but maximum percentage they will experiment is 30%. Remaining 70% will definitely be from this material, that is Digirao Academy material only. So you just go with this problem itself. Just prepare it well. So for the other problems, that is problem number 2, 3, 4, 5, 6, which are the very old problems. But then they might ask in exams. We are like, it's not like you should not study those problems. You should definitely work out that problems also. 2, 3, 4, 5, 6. What I will do now is I'll just explain you the problem and I'll just show the institute material. So that what you can do is you just go with the institute material for the solution. Okay, for this problem. For these problems, just go with the institute material. I'll explain you the question and I'll just explain you the institute material answer so that you can understand when you read what is there. So we have already solved all the problems. Just these problems are like final problems actually. These 4 problems. So it is like in exams we have solved all the examination problems. So you won't see these kinds of problems in the examination problems because these are all like final basic problems. Okay, first is 6th problem I just explained. A product is currently manufactured on a machine that is not fully depreciated for tax purpose and has a book value of 70,000. See, there is some currently manufactured on machine. A product is being manufactured on machine that is not fully depreciated for tax. So there is some amount that is book value which is left, that is 70,000. It was purchased for 2,10,000 20 years ago. Okay, the purchase value is 2,10,000 and the book value left is 70,000. So how much is the already calculated value? Already book value which has been depreciated, 2,10,000 minus 70,000, you will get what is the book value which has already been depreciated, that is 1,40,000. So already it has been put in use for 20 years. 1,40,000 divided by 20. For every year, depreciation is 7,000 rupees. Okay, done. The cost of the product are as follows. So they have given the cost of the product that has been manufactured. Direct labor 28 rupees, indirect labor 14 rupees, other variable overheads 10 rupees 50 paise, fixed overhead 17 rupees 50 paise. So the total cost is 70 rupees. Out of the first 3 are variable cost, last one is fixed cost. So in past year, 10,000 units were produced. So total number of units produced in past year is 10,000. It is expected that with suitable repairs, the old machine can be used indefinitely in future. So if you make some repairs, you can use the machine indefinitely in future without any time period restriction. The repairs are expected to be average at 75,000 per year. So for every year, if you are spending 75,000, then you can use that machinery for lifetime. That you can keep using that same machinery. So for using the old machinery itself, the cost which should be incurred every year is 75,000. That is point number 1. And an equipment manufacturer has offered to accept the old machine as a trade-in for new equipment. The new machine would cost 4,20,000 before allowing the 1,05,000 for old equipment. See, there is a manufacturer. Someone is manufacturing the same machine. He has given a quotation that I will take back the old machine and I'll give you the new machine. So new machine cost is 4,20,000. On that 1,05,000, I will reduce it for taking back the old machine. So old machine value for which it is being sold 1,05,000. What is the value of the machine as per book? 70,000. Remaining amount is short-term, long-term capital gain. So on that capital gain, there is some tax which you should pay. So that is the loss. So one more cash outflow is if you are going for new machine, then you are going to lose 35,000 into tax percent. How much is the tax percent? They would have mentioned 50% is the tax percent they have mentioned. So 35,000 into 50%, 17,500 is the cash outflow. So next, the project costs associated with the new machine are as follows. So because of change in new machinery, if suppose you are going for new machinery by signing this deal, then the cost is direct labor will fall to 14 rupees before 28 rupees. Indirect labor will increase to 21 rupees. Other variable overhead will fall to 7 rupees and fixed overhead will increase to 22.75. So the total cost is 64.75 under new machinery. The fixed overhead cost are allocations for other departments plus depreciation of the equipment. So in this fixed overhead, there is already depreciation which has been included. So for the old machine can be sold for 50,000 in open market. So if you take that old machine to the open market, you are going to sell it for 50,000. So how much is the profit you are making? 1,05,000 minus 50,000. So 55,000 rupees profit you are making. The new machine is as expected a life of 10 years and salvage value of 20,000. So 4,20,000 is the price of the machine minus 20,000 salvage value, 4 lakh divided by 10 years. So you will get 40,000 as depreciation every year. Before the depreciation was 7,000. So now because of change in machinery, change in new machinery, incremental depreciation is 33,000. So on the 33,000, you are going to get some tax savings. The current corporate income tax rate is assumed to be 50%. For tax purposes, cost of new machine and the book value of old machine may be depreciated in 10 years. So for tax purposes, always it should be depreciated for 10 years. The minimum required rate of return is 10%. That is discounted rate is 10%. It is expected that future demand of the project will stay at 10,000 units per year. So future demand will always stay at 10,000 units per year. There will be constant 10,000 units requirement every year. The present value of annuity of rupees 1 for 9 years at 10% discount factor is 5.791. The present value of rupees 1 received at the end of the 10th year for 10% discount factor is 0.386. That is, they have given annuity factor for 9 years. That is summation of all 9 years. 10% factor they have given annuity factor 5.759, and for 10th year they have given the PV factor, that is 0.386. So should the new equipment be purchased? So you should compare the old equipment and the new equipment, and you should see the incremental value and tell whether the new equipment should be purchased. So that is the question. Solution, see that solution alone. Very easy sum, but the thing is it will take little bit time for solving it. So you just, I'll just explain you the problem. You look into your institute material and just copy the format, that is take down the solutions. So now we'll just solve it in the video. So see, basically there is cash inflow and cash outflow. That is some cash inflow and there is some incremental cash outflow also. So first we will calculate what is the net cash outflow. So see, currently if you are going for new machinery, what is the incremental net cash outflow you are going to pay? Old machine, you are going to sell it for 1,05,000 and you are going to purchase 4,20,000. So 4,20,000 is the cost of new machine. For that exchange price, how much you are going to give? 1,05,000 you are going to give machine and deduct the 1,05,000 from that 4,20,000. So remaining 3,15,000 is the net purchase price. On that, see, because you are selling your old machinery at higher rate than the book value, you are having some long-term capital gain. That is, see, 70,000 as per your books. Okay, 70,000 is your book value, whereas you are selling it for 1,05,000. So 1,05,000 minus 70,000, you are selling it for extra 35,000. This extra 35,000 is nothing but long-term capital gain. So in long-term capital gain, always you are going to pay tax. Okay, when there is a long-term capital gain, you are going to pay some tax. So that is a loss. So that is an outflow. That is not a loss. It is an outflow. So what is the cash outflow for long-term capital gain? Tax rate is 50%. The extra amount for which you sold is 35,000. So 1,05,000 you sold the purchase, but the value of the machinery in books is 70,000. So 35,000 is the incremental, that is long-term capital gain. On that 50%, that is 17,500 is the long-term capital gain which you are going to pay. Okay, so you understood this. What is 17,500? It is nothing but for 1,05,000 you are selling it, but book value is 70,000. So 35,000 is the profit. On the profit, 35%, 50% is the long-term capital gain. So you should add that to the, that is also in cash outflow. So net purchase price is 3,15,000. On that, if you add the cash outflow by way of tax, you'll get what is the net cash outflow. That is incremental cash outflow, incremental present value of cash outflow. So all these are incurred on the beginning of the year 0 itself. So into 1 you will get present value of cash, incremental cash outflow, that is 3,32,500. So this is present value of cash outflow. Now we should calculate what is the present value of cash inflow. See, simple man, cash inflow can be compared by comparing the revenue and the cost incurred for producing the products. Okay, for existing, how much is the, for existing machine, how much is the cost and revenue, and for new machinery, what is the cost and revenue. If you compare both, you will get what is the incremental cost and revenue. So if you minus revenue minus cost, you will get what is the incremental cash inflow. If you deduct cash inflow minus cash outflow, you will get what is the NPV. If NPV is positive, then go with new machine. If NPV is negative, then go with old machine, existing machine. So below that, next step, that is incremental cash inflow we are going to find. Same way, 4 column I am going to put 4 column table, existing, new and incremental. So here incremental is nothing but B minus A. So new minus existing. For new, how much is the incremental you are spending, or incremental you are going to receive cash. So that is the, your incremental is equal, incremental here in this particular sum is A, B minus A. Or you can even take A minus B. That is up to you. Whereas if it is revenue, you should calculate what is the incremental cash inflow. Whereas cost, what is the incremental cost? Then compare the deduct the incremental cost from the incremental revenue, you will get incremental net present value. So here number of units under both the options they told 10,000 units. So variable cost per unit. So add all the first top 3 costs, that is and variable cost. So you will get under existing it is 52.5, under new it is 42. Fixed cost we should not take because we are calculating variable, total variable cost. So total variable cost is 5,25,000 under existing. Under new it is only 4,20,000. So you are going to save some amount here in variable cost. How much you are going to save? See, 5,25,000 I am going to expend if I am going with existing, and if I am going with new, I am going to spend only 4,20,000. So I am going to save nearly 1,05,000 rupees. So increment column. So this has gone up. Actually, this should come one step down. So it has gone up. Just bring it down. So 5,25,000 minus 4,20,000, you will get 1,05,000 profit. So that incremental, that is savings in cost, is nothing but incremental cash inflow. Here there is savings in variable cost. So it is a cash inflow. Next is repairs. See, repairs, if suppose you are going with new machinery, you are not going to spend on anything on repairs. Whereas if you are going with old machinery, you should spend 75,000 per year. So because of going with new machinery, you are going to save that 75,000 every year. So it is an incremental cash inflow. So you should add it. So below that 1,05,000, you should record 75,000. So next, see, these two are increment reduction in cost. So when there is reduction in cost, that is incremental cash inflow. So these two are cost has been reduced. So there is cash inflow. And next is depreciation. See, depreciation, if you are going with old machinery, then 7,000 is what we found. That is 2,10,000 is the cost of machinery. Okay, 21 years ago. Now it is 70,000. So 2,10,000 minus 70,000. How much is the depreciation has been provided till date? 1,40,000 has been depreciated. So 1,40,000 has been depreciated for 20 years. So divided by 20, you are going to get 7,000 rupees. So in the existing scheme, depreciation is only 7,000 rupees. Whereas under new scheme, if you are going for new machinery, total cost of machinery is 4,20,000. On that 20,000 is the salvage value which they have given. So minus 20,000. So 4 lakh is the net fixed cost available for depreciation. So 4 lakh divided by how many years they have given for taxation purpose depreciation? 10 years. So you are going to get 40,000. So under old machine only 7,000. Under new machine 40,000. So incremental depreciation is 33,000. So 33,000 has been deducted from the profits. Extra 33,000 has been deducted from the profits because of change in machinery. So that is incremental cost. So you should deduct it. Just deduct the incremental depreciation. Because of more depreciation, your cost is coming. Your cost is increasing. Your profit is coming down. So existing only 7,000 is the depreciation cost. But whereas new machinery 40,000 is the depreciation cost. Because of this, I am paying extra 33,000 cost. So you should deduct it. There is increase in cost, so you should deduct it. Now you should total it. You will get 1,47,000. It is nothing but total savings before tax. Nothing but profit before tax. On that, if you take a 50% taxation, you will get what is profit after tax. On the profit after tax, if you add back the incremental depreciation, you will get what is the CFAT. Simple. Incremental depreciation, you will deduct from the cost. Then you will deduct the tax. Again, you will add the depreciation so that you will get CFAT. See, as simple as that. See, always depreciation. When there is depreciation, what you will do? You will deduct it from the profits so that your profits will come down. On that remaining profits only, you will pay tax. So depreciation is something we are using it to reduce the profits in order to reduce the tax. So here there is incremental depreciation. So your tax is getting reduced. So you are using higher depreciation amount. So there is incremental depreciation and remaining amount you are paying tax and adding the incremental depreciation back to the PAT because we want CFAT. On the CFAT, you should multiply the present value factor. On the CFAT, on the CFAT, you should multiply the annuity factor because every year you are going to save 1,06,500. So below that, terminal cash inflow, that is, this is one cash inflow every year, that is 1,06,500. On that, if you multiply with the annuity factor for 10 years at the rate of, what is the percentage? 10%. You will get what is the present value of cash inflows. Again, this terminal cash inflow, that is 20,000 salvage value, at the end of 10th year, you are going to receive. So on that, you should multiply with the present value factor for 10th year at the rate of 10%, so that you will get what is the present value of the salvage value. So if you add both and deduct the present value of cash outflow, you will get what is the incremental cash inflow, that NPV. So simple calculation of NPV is nothing but operating cash inflow for 9 years, 1 to 9 years, that is 1,06,500. Okay, 1,06,500 into what is the 9 years you are going to receive. This is the 1,06,500 is in for 9 years you are going to receive this cash inflow, incremental cash inflow. So 1,06,500 into 5.759. So that is annuity factor for 9 years. So if you multiply with it, you will get what is the present value of cash inflow. And next, if you add 1 lakh for 10th year, how much you are going to receive as cash inflow? 1,06,500 plus this 20,000 at the end of the 10th year. So 1,26,500 into for 10th year, what is the present value factor? 0.386. So if you multiply with 0.386, you will get 48,829. If you add both, you will get what is the total present value of cash inflow. From that, if you deduct the cash outflow, that is 3,32,500, which we found by calculating cost of machine and deducting the exchange value of machine, you will get what is the NPV. Here NPV is positive, so it is advisable to replace the machine. So this basically this is how all the problems will be. Okay, you just solve these problems, all these second, third, fourth, fifth, and sixth problem. So I have explained you sixth problem also. In the same way, this all 4 problems, that is 2, 3, 4, 5 will also be second problem, third problem, fourth, and fifth problem. All these 4 problems will also be in the same line. And one more problem I'll explain, that is problem number 4. Again, same method. Whichever is little bit important, I'm just explaining it. They might cover these kinds of problems in exam, but mostly whatever they have dumped under exam problems, definitely those kinds of problems will only be asked. See what they are given for problem number 4. A chemical company is considering replacing an existing machine with one costing 65,000. Okay, chemical company is planning to replace existing machine with the new one costing 65,000. The existing machine was originally purchased 2 years ago for 28,000 and is being depreciated by straight line method over its 7 years life period. So 28,000 divided by 7, you will get 4,000 rupees every year. So right now the value of the machine is today is 20,000. So it can currently be sold at 30,000. So the current sales value is 30,000. The new machine would cost 10,000 to install and would be depreciated over 5 years. So to install the machine, it will cost 10,000 and it will be depreciated over 5 years. The management believes that new machine would have a salvage value of 5,000 rupees. So salvage value of new machine is 5,000 at the end of year 5. Okay, done. The management also estimates an increasing net working capital requirement of 10,000 rupees. See, when there is increasing net working capital requirement, there is present value of cash outflow every year. That is, there is cash outflow every year of 10,000 rupees, and the 10,000 rupees will be multiplied with the present values in order to bring to the present value of cash outflow. Bring the values to the today's value. As a result of expanded operations with new machine, the firm is taxed at the rate of 55%. Oh my god, the tax rate is 55% on normal income and 30% on capital gains. So because of selling the machinery, how much is the capital gain? That is the tax at 30%, whereas normal tax rate is 55%. The company expected after-tax profits for next 5 years with an existing mission and new mission are as follows. See, with existing mission, what are the different cash inflows? With new mission, what are the different cash inflows? Just calculate it and find the incremental cash inflow. On the incremental cash inflow, if you multiply with the PV factor, you get what is the present value of incremental cash inflow. You total it, you get total present value of cash inflow. Total incremental present value of cash inflow. From that, if you deduct the present value of cash outflow, you'll get what is the incremental NPV. If your incremental NPV is positive, then go with mission, go with existing mission. Sorry, new mission. If your incremental NPV is negative, then go with old mission itself. Calculate the net investment required by new mission, that is present value of cash outflow, which is nothing but net investment required by new mission. Next, if the company's cost of capital is 15%, determine the new mission should be purchased. Determine whether new machine should be purchased. That is, if incremental NPV is positive, then new machine can be purchased. If not, it should not be purchased. So that is the question they have given. They have given what same problem number 6, but here one changes. They have given the expected after-tax profits directly. So if you compare both, what is the incremental after-tax profits? On that, if you multiply with the present value factors, you will get what is the present value of incremental cash inflow. So just see. First, we will calculate what is the present value of incremental cash outflow. The cost of new asset, man. The cost of new asset is 65,000. Upon that, you are going to spend 10,000 as installation cost. So if you add both, total cost spent is 75,000. Apart from that, 10,000 as working capital every year. See, they have given the management also estimates increase in net working capital requirement of 10,000. So 10,000 every year you are going to spend. So add additional working capital of 10,000. Okay. So see, net working capital requirement of 10,000 as a result of expanded operation means at the beginning of the year 0, you are going to put in extra 10,000 rupees in working capital. So which you can't take back. So the 10,000 rupees once put in at the year 0 is going to be in the working capital. So that is also an expenses on year 0. That is at the beginning of the year 0. And also the purchase of new machinery 65,000 and 10,000 rupees installation cost is also an expendings, that is spendings. So total of 85,000 you are going to spend. That is cost of new asset, installation cost, and additional working capital. 85,000 you are going to spend at the beginning of the year. From that 80,000, how much you are going to pay using the sale process of the machine? So machine you are going to sell at 30,000. Okay. From the 30,000, just deduct how much is the tax you are going to pay. See, 30,000 rupees, man. There is no removal cost. So okay, happy. There is no removal cost. But for you are selling this machinery at 30,000, whereas you purchased it at 28,000 and you used it for 2 years out of 7 years. So 28,000 into 5 divided by 7 is the present value. That is today's value of machinery. So 20,000 worth machinery, you are going book value, you are going to sell at 30,000. So 10,000 is the long-term capital gain. So 10,000 into how much is the capital gain percentage? 30%. Into 30%, that is 3,000 should be 10,000. Okay. Here, see, understand this. If you would have solved this in DT, up to the total cost, that is cost of machinery, normal percentage of taxation will be charged. And more than that cost of machinery, anything excess long-term capital gain, on that, this special capital gain taxation will be used. Here, we found that 20,000 is the today's value of machinery. Okay. How did we find that? 28,000 for 7 years they have given. The life of the machinery is 7 years. We have already used for 2 years. So remaining years is 5 years. So that is 20,000 is the today's value of machinery as per book value. Whereas you are selling at 30,000. So 30,000 minus 20,000, you are selling at 10,000 rupees profits. So see, up to 28,000, you are selling at 30,000. Whereas the book value is 20,000. So 10,000 is the profits. Whereas this 8,000 rupees, that is 20,000 to 28,000, that is 8,000 rupees is within the original cost of machinery. So on that 8,000, 55% is the tax rate, and above 8,000, that is remaining 2,000, this 30% is the tax rate. So 8,000 into 55% divided by 100 and 2,000 into 30% divided by 100. So that is the tax amount on which you should deduct it from the sale profits because you are going to pay the tax on out of that sale profit. So 30,000 minus 5,000, you are getting 25,000. So 85,000 minus 25,000 is the net investment required. That is the present value of cash outflow. Understood? So simple, same calculation. Cost of new asset, add installation cost, add additional working capital. From that, deduct the sale profit which you are getting from the old machine. So 30,000, on that we are paying some tax. So the tax should be deducted from the sale profit. Remaining amount will only be received in cash. So that cash remaining received in cash should be deducted from the cost of investment, cost of new asset, so that we get what is the present value of cash outflow. So 60,000 is the present value of cash outflow, and also calculate what is the present value of cash inflow. Simple, present value of cash inflow, you can compare the cash inflows, that is after tax profits, and find the incremental, that is 2 lakh 30 minus 2 lakh 26,000. On that, if you multiply with the present value factor at the rate of 15%. Why 15%? Here they are given clearly that cost of capital is 15%. So if you multiply incremental amount with the PV factor of 15%, you will get present value. So if you summarization of all the present values is the present value of cash inflows for 5 years. Apart from this cash inflow, you are also going to get a cash inflow of salvage value 5,000. So at the end of 50 year, 5,000 rupees you are going to receive. So on this 5,000 into present value at the rate of 15%, present value factor at the rate of 15% for the 50 year. If you multiply that with the 5,000, you will get what is the present value of salvage value which you are going to receive. So add that to this present value of cash inflow. So salvage value is the total cash inflow at the end of 50 year you are going to receive. And also in working capital, you dump 10,000 at the beginning of the year 0. So which at the end of the year 5 you are going to take it back. So working capital recovered 100% will be recovered at the end of year 5. So that amount, that is 5,000 plus 10,000, that is 15,000 into present value factor at the rate of 15% for 50 year. If you multiply it with that, you will get what is the present value of cash inflow at the end of 50 year. So present value of cash inflow for 5 years plus present value of cash inflow at the end of 50 year. If you add both and if you deduct the cash outflow, present value of cash outflow, that is 60,000, you will get what is NPV. So NPV is positive in the sum. So it is advisable to accept the change in machinery. That is new machinery can be purchased. It is advisable to change in machinery. So this is problem number 2. So basically the problems will be in the same line, whether to accept or not to accept the change in machinery. Whether to accept or not to accept the change in machinery. So that is what we are going to solve in all the problems. So problem number 2 is pakka same. Problem number 2, you just mark it as homework. Just work it on your own. 10th illustration. That is in book it is in the institute book it is problem number 10. Illustration 10. See, illustration 10 is the problem number 2. Illustration 10 is the problem number 2. First you should calculate what is the cash outflow, then you should calculate what is the cash inflow, then you should calculate what is the net present value. On that you should comment on it. Simple, same steps. So problem number 2, if you read, you can solve it. And we will also have discussion on this one more problem, that is problem number 3. So problem number 3 is also a final problem. That is a final CMA final problem. We did this in CMA final where when we were doing inter, we didn't do this sums in inter. Whereas now it is applicable for inter. They are given in the material, institute material also in inter, and sir is also given in material. So problem number 3, Techotronics Limited, an existing company, is considering a new project for manufacture of pocket video games involving a capital expenditure of 600 lakhs and working capital of 150 lakhs. The capacity of the plant, see, first there's a company, existing company is considering a new project. It requires the capital expenditure of 600 lakhs. So today I'm going to spend 600 lakhs as capital expenditure, and also I'm going to put in 150 lakhs as investment in working capital. So total 750 lakhs I'm going to put in today. That is 750 lakhs is the expenses I'm going to incur today for that particular project. The capacity of the plant is for annual production of 12 lakh units, and capacity utilization during the 6 years working life of the project is expected to be indicated as below. See, it is 12 years, that is 12 lakhs units you can produce. That is the annual production capacity. And for 6 years, what is the capacity utilization is? For the first year, it is 33.313%, that is 4 lakhs. For second year, it is 8 lakhs. For third year, it is 10 lakh 80. And for fourth year, it is entire 12 lakhs has been produced. The average price per unit of the product is expected to be 200. The average price per product is expected. See, this is not 4. This is 4-6. In institute material, they have given 4-6. That is the total number of capacity utilization for fourth year to sixth year. That is from fourth year to sixth year, the project has used the entire 100% capacity of the machinery. So 4 to 6 years. So the average price per unit of the product is expected to be 200. That is selling price per unit is 200. Netting the contribution 40%. So contribution per unit is 40%. Annual fixed cost excluding depreciation is 480 lakhs. So excluding depreciation, annual fixed cost is 480 lakhs per annum from third year onwards. That is annual fixed cost excluding depreciation are estimated to be 480 lakhs per annum from third year onwards. For the first and second year, it will be 240 lakhs and 360 lakhs. So from third year and 4 to 6 years, in this two combination, that is third year and the 4 to 6 years, the fixed cost is 480. And for first year and second year, it is 240 lakhs and 360 lakhs. The average rate of depreciation for tax purposes 33.33% on the capital asset. So here capital asset is nothing but 600 lakhs on that 33.33, that is 200 lakhs is the depreciation for every year. No other tax reliefs are anticipated. The rate of income tax to be taken at 50%. Done. So the depreciation is 200 lakhs every year. And one more thing is fixed cost is 240 lakhs and 360 lakhs for first year and second year. And from third year to sixth year, it is 480 lakhs. Below that, at the end of the third year, an additional investment of 100 lakhs would be required for working capital. So at the end of third year means in the third year bucket. So you are calculating this third year at the end of the third year. So in this third year bucket, you should add the additional working year, that is present value of cash outflow. That is at the end of third year, the outflow is 100 lakhs. So present value factor at the end of third year for 15% you should calculate. If you multiply it with the 100 lakhs, you will get what is the present value of that cash outflow on the third year, at the end of the third year for working capital. And the company, without taking into account the effects of financial leverage, has targeted rate of return 50%. So this cost of capital is 15%. You are required to indicate whether the proposal is viable, giving your notes and analysis. So you are going to calculate what is the whether it is giving positive incremental cash inflow. That is whether the net NPV is positive or negative. We should find. First, we should calculate what is the present value of cash outflow. Then we should calculate what is the present value of cash inflow. From that, we can easily find what is the NPV. So the terminal, they have also given the terminal value of fixed asset. Terminal means salvage value of fixed asset may be taken at 10%. Here the fixed asset is nothing but 600 lakhs plus 100 lakhs, that is 700 lakhs. And for the current assets, 100%. So the entire working capital which has been put in, that is 150 lakhs and the 100 lakhs. So 250 lakhs can be taken back at the 250 lakhs itself. So at the end of the year, which year? At the end of year 6, that is at the end of the 6th year, you are going to take back 10%. Terminal value is 10% of the, that is cash inflow is 10% of the fixed asset. So 600 lakhs into 10%, that is 60 lakhs is the cash inflow. And at the end of the last year, current assets, that is working capital, 150 lakhs plus 100 lakhs, 250 lakhs is the cash inflow. So calculation may be rounded off to lakhs of rupees for the purpose of your calculation. The recent amendments to tax laws with regard to the balancing the charges may be ignored. So this is very easy. I still remember this we solved in the final examination. The final set of for SFM, cost and fit. For which chapter did I study this problem in final? It's on a strategic financial management, SFM. Yeah, SFM under capital budgeting chapter, I studied this problem number 3. Okay, then moving on to the answer. See, very simple. First, we should calculate what is the present value of cash outflows. Then we should calculate present value of cash inflow. In comparing both, we should calculate NPV. If NPV is positive, accept the proposal, or else reject the project. That's all. First, calculate present value of cash outflow. See, at the beginning of the year, I'm spending 600 lakhs. Then 150 lakhs. So 600 into 150. 150 into 600 into 1, 150 into 1. Then again at the end of third year, I'm spending how much I'm spending at the end of third year? 100 lakhs. So 100 into 15% at the rate of, that is present value factor at the rate of 15% for third year. How much is it? For third year, 15% is 0.66. So 100 into 0.66, 66. So all these are cash outflow. So summarization of all this is present value of cash outflow. Simple. So again, next is present value of terminal cash inflow. So at the end of the year, how much you are getting as cash inflow? That is at the end of sixth year. So you are going to get 10% of the how much they are given. You are going to get 10% of the fixed asset. 600 lakh into 10%, 60 lakh. So what is the present value factor at the rate of 15% for sixth year? So 15% for sixth year is 3.5. Once again, salvage value 600 into 10%. You are getting 60. There is tax on profit of 50%. That is C. If you are calculating depreciation, that is on 600 lakhs at the rate of 33.13. That is 200 lakhs every year. The average rate of depreciation for tax purposes 33.13 on the capital assets. So they are given percentage. So it is written down value method. So 600 lakhs into 33.33%. You are getting 200. So 600 minus 200. So at the end of that is for the second year, the fixed asset amount is 400 lakhs into again 33.33%. You are getting 133. So what is the value of machinery at the, that is fixed asset at the end of second year? We can just multiply with the 66.66% every year. So at the beginning of the year, 600 lakhs into 66.66%. You are getting 400. So at the end of second year, it is 400. So at the end of first year, it is 400. At the end of second year, it is 266. And at the end of third year, it is 177. Fourth year, it is 118. And fifth year, the value of fixed asset is 78. And sixth year, the value of fixed asset is 52.6. That is approximately 53 rupees. So 53 lakhs approximately. So 60 lakhs is the sales value. That is at the end of the project. That is at the end of sixth year, you are going to get back 60 lakhs. Whereas the book value is 53 lakhs. So the remaining 7 lakhs is the capital gain. On that 7 lakhs, you are going to multiply it with the tax rate. That is here the tax is 50%. So 7 lakhs into 50%, that is 3.5 you are going to pay. So 60 minus 3.5, remaining is 56.5. So that is 56. 3.5 rounded off. So 56. 56 is your profit on sale of that machinery. Okay. 56 is your total salvage value. That is profit on sale of your machinery. On that, again, add working capital. You are investing 150 lakhs at the beginning of the year and 100 lakhs at the third year end. So you are going to take back 150 plus 100. That is 250 lakhs at the end of the sixth year. So 250 into same. What is the 15% for 6 years? If you multiply, you will get what is the present value. You just add what is the values. So salvage value is 60 and 3.5 is the tax which you are going to pay on the long-term capital gain. So if you deduct that, you are going to get round of 56. So 56 plus 250, you are going to get 306. So 306 is the terminal value. So multiply the 306 with the present value factor, that is 0.432. If you multiply it with it, 132 lakhs, that is 132 is your present value of terminal cash inflow. So if you add terminal cash inflow with the present value of cash inflow, you'll get what is the total present value of cash inflow. Now we calculated what is the present value of cash outflow, and we calculated what is present value of terminal cash inflow. Now next, what we should find? We should find what is the present value of cash inflow. So present value of cash inflow, simple, we can easily find. See, 200 rupees is the selling price. Okay, and total production is, we should multiply this production rate with the 12 lakhs. That is, see, total 12 lakh units can be provided. That is produced. On the 12 lakh units, what is the selling price per unit? 200. See, first year 1/3 of the capacity utilization, so 4 lakh. Okay. See, production 4 lakh, 8 lakh. They are given in the thousands for production. You can even calculate using lakhs. 4, 8. You can take in the lakhs itself, or if you are going with thousands, so it's fine. 400, 800. So third year it is 90%. So 12 lakh into 90%, it is 1080. And for 4, 5, 6, change it to 4 to 6. So 4, 5, 6, it is 100%. So 1200, 1200, and 1200. So what is the contribution? Just calculate contribution. Contribution is nothing but selling price minus distribution. Selling price minus variable cost. See, 200 is the average price per unit of the product produced is expected to be 200, whereas netting of contribution of 40%. Okay, so one second. So 200, they have given 200 rupees. On that 40%, you are going to get 80. So netting of a contribution of 40%. So how much is the contribution you are going to get? If suppose from this 200, if you deduct 40%, you will get contribution. That is what they are telling. 200 netting of a contribution of 40%. So if you deduct from this 200, 40%, you will get what is the contribution. So 200 minus 20%, 200 into 40%, how much you are getting? 80. So 200 minus 80, you are going to get 320. Sorry, wait. Production, then contribution. From contribution, if you deduct fixed expenses and depreciation, you will get PBT. How is this contribution came 320 here? The average price per unit of the product is expected to be 200, netting a contribution of 40%. So, what is the selling price per unit? 200. So 200 into 40%, you are going to get 80. What is your 800? We'll see the in-sheet material question itself. There is some mistake here. Oh my god, they have calculated the total contribution. So don't take this as see, when you are taking notes, don't take this production as 400, 800, 1200. Just take it as, if you are having institute material in your hand, just strike off all these double zeros. It is 4, 8, 10.8, 12, 12, 12, all 3 or 12. So that is the production. So contribution is the total contribution. So here 200 rupees is the sale value. On that 40% is contribution. So 200 into 40%, you are getting 80 rupees per unit as contribution. So 80 into 4, how much you are getting? 320 contribution. 80 into 80 into 8, 640. 80 into 10.8, 864. 80 into 12, 960, 960, 960. So contribution per unit, how did we find? 200 into 40% is the contribution per unit. That is 80 rupees. If you multiply with the production, you will get total contribution. From that, if you deduct fixed expenses, how much is the fixed expenses? For first year, it is 240. Second year, 360. For all remaining years, 480. So if you deduct that, you will get again deduct depreciation. How to deduct depreciation? Depreciation, see, for first year, depreciation is 600 lakhs is the capital expenditure. So 600 into 33.33%, you are getting 200. So for first year, it is 200. So if you deduct 200, remaining how much is the capital expenditure left over? How much is the fixed asset book value left over? 600 minus 200, you're getting 400. So on that 400 for second year, again calculate 33.33%. So 133.33, that is 133 is the depreciation for the second year. So record 133. Again minus 400, that is 400 minus 133, you are getting book value at the end of year 2 is 267. Again into 33.33%, you are getting 89. So in respect of third year, depreciation is 89. So for this all 6 years, calculate what is depreciation. Now from contribution, take off fixed expenses and depreciation. You get PBT. From the PBT, take off profit after tax. So profit after tax is 50. That is tax is 50%. So if you take 50% from the PBT, you will get PAT. So 120 into 50%, 60. So add 60, you will get minus 60. So 147 into 50, you will get 74. 295 into 50, 148. Everything we are rounding off to 0.5. That is, if it is 0.5, you are rounding off to the next number because they gave rounded off to the lakhs. So PAT will get, on that PAT, if you add depreciation, you will get CFAT. So minus 60 plus 200, you will get 140. 74 plus 133, you will get 207. CFAT. On the CFAT, if you multiply with the present value factor at the rate of 15% for all 5 years, 6 years, you'll get what is the present value. Summarization of that is present value of cash inflows. Present value of cash inflows plus present value of terminal cash inflow, you will get 958. From that, if you take off total present value of cash outflow 816, you will get NPV, that is 142 lakhs positive. So it is positive, hence it is advisable to implement the new project. So simple sums, but you required some time to understand the sums. Just read the problem properly, then come to the institute material, step by step, why this step has been calculated. Just take one step, then solve it. Then again see the question, solve the second step, third step, go one by one step. I am not solving this in the notes only because one is these problems. See, like examination problem, we have solved all these 7 problems which are very important, which are going to be repeated in exam. And these problems are like, these are from final problems. Like if you want notes, I can even give you notes. If you want the notes, like a written notes, if you want, I can solve that problems and give it to you. If you want it, you just message me and ask. I'll just send you the printed note, that is written notes for this problem. So that is problem number 2, 3, 4, 5 and 6. So with that, we have completed the capital budgeting. So capital budgeting is over with that. See, we have completed all the chapters of this FM. So with that, FM is over. So moving on to the next, that is costing. From like from tomorrow or by day after tomorrow, I'll be starting recording this costing. So if you have any doubts regarding FM, that is financial management, just you can message me and ask what is the doubt. And also, if you want me to solve some problem in the like video, suppose if you want me to explain that problem, it's fine. You can ask me in the WhatsApp. I'll just try to explain it. So with that, FM is over. That is financial management is over. That is 50 marks of the paper is over. Just start preparing well. That is, finish off your financial management before itself, before receiving this costing video. So costing videos you might receive next week. So before that itself, finish off this financial management. So okay guys, all the very best, prepare well. We'll see in the costing video. Thank you.